Assalamualaikum. I welcome you all on behalf of Art University. Welcome back from winter vacation. Today we will start with a new chapter that is about investment alternatives, direct and indirect investment, and we will study different type of investment, different type of financial instruments in this type of direct and indirect investment forms. Categories of investment, we have two broader categories of investment, that is direct investment and indirect investment. Direct investments are those investments where you take actual direct ownership of an asset and you own the asset by your own self and do investment by your own after doing all the homework regarding investment. Indirect investment is that investment that is done indirect with their indirect ownership, such as mutual fund, such as real estate, such as other purchasing of cars, purchasing of property, purchasing of land, purchasing of mutual funds, bonds, mutual funds, purchasing of financial bonds, and purchasing of any other instruments in which dealer is involved, third party is involved, any firm is involved, any agent is involved. This process is known as doing indirect investment. Money market instrument. What are money market? Money market is comprised of high quality, short term, large denomination debt instrument. What money market is? Money market is a market whose life is less than 365 days, as money is most liquidable cash item, and the instrument which are dealt in money markets are usually currencies, Pakistani currency, foreign currency, dollars, pounds, euros, etc. High quality money market instruments are generally the issuers have very high credit rating, like they are big US government, Pakistani government, money central banks, State Bank of Pakistan, many other banks, Central Bank of England, Federal Reserve Bank of United States, large financial companies, blue chip corporation. Blue chip corporation are those companies which are high quality companies which are best of the best in their own field in every term, in terms of their financial performance, in terms of their HR performance, in terms of their sales performance, in terms of their market share in the world. So blue chip companies, mostly these are multinational global companies, and they issue these high quality money market instruments. But its life is less than 365 days. Remember, short-term money market instruments. These most money market instrument mature within 1 year, less than 365 days, and many within a few days. That money market instrument life is start from even an hour, 1 hour, 2 hour, 3 hours to 365 days. But short term has small life like some few days, and high quality have large life like 365 days. Right? This is basic difference in that money market instruments. Large denomination. Most of the securities have face value greater than one lakh dollars, and additionally, most of these investments are discount securities. They do not pay interest, rather they are sold at discount to the face value, later redeemed at full face value. Large denominations money market instruments are issued by big companies, multinational companies, or the government when they are in need of money. Private organization or government organization both issues large denomination of money market when they are in need of money, but its face value is usually it is sold at discounted. Like if the face value is 1 lakh, it is sold at 95,000, 98,000, 99,000. There's 100 or 1,000 rupee discount which is given to the general public or big investor is usually given to attract them to buy this large denomination money market instrument, and when they are pay back, they are sold at face value. Like if the face it is written 1 lakh, it will be sold at 1 lakh. But when they are given, they are circulated to the investor for buying by the companies or by the government, they are given a discounted rate. Types of money market instruments: treasury bills, short-term agencies, short-term municipal bonds, commercial paper, bankers acceptance, jumbos, center of deposit, brokered center of deposit, large center of deposit, and repurchase agreement. We will discuss each one of them in next slides and upcoming slides. Treasury bills and short-term agencies. Treasury bills is a short-term US government debt obligation backed by Treasury Department with a majority of 1 year or less than 1 year, and these bills are backed by full support and faith of the government. Here we are defining it in the terms of US government, but it is issued by any government. Pakistani government also issued it, Indian government also issued it, and all over the world these are issued by the government when they are in need of money with a maturity of 1 year or less than 1 year, and its support of the full support of the government when they issue these treasury bills. These are issued with original maturities of 4 weeks and 13 weeks or 26 weeks or 2 weeks, but they are less than 365 days. Usually they issued in 4 weeks time, 13 weeks time, 26 weeks time, or 2 weeks time. But mostly they are issued for 1 year and within the 1 year. Occasionally they are issued cash management bill with variable but less than 3 months of maturities. They do not pay interest. Instead, they are sold at discount to face value and redeemed at maturity for their first face value in future. What they do? Government issue treasury bills at discounted rate. Like if the face value is 1 lakh, they are not sold out at 1 lakh. They are given to the investor, sold to the investor at less than face value. And when they are bought back by the government, treasury bills are usually bought back by the government from the investors when the government financial position is good. They are bought back at the face value. If it is 1 lakh return, they will buy back at 1 lakh. But when they are sold by the government, they are given on the discounted rate less than their face value. Clear? Short-term municipals, short-term municipal, short-term municipals. What are short-term municipal bonds? These are basically bonds issued by the corporate firms or corporate companies, but mostly they are issued by the government bodies at local level. Like municipal committees are exist at all local level, and these bonds are issued by a municipal committee. It is a government body, and they issued for shorter period of time. Cities, countries, and states all frequently have a need for short-term funds to provide for liquidity needs, so they can issue securities that are similar to treasury bills called anticipation notes when they need money. So, local government department or municipal department or any local government department or state department which is not governed under central government but under the provincial government, when they are in need of money, these are issued by they issued short-term municipal bonds. So remember, difference between short-term municipal bond and other corporate bond is that corporate bonds are issued by private entities and municipal bonds or local government bonds are issued by government bodies. And at municipal level, at local level, when they are in need of money, and still they and the value is it is done because they provide a good interest rate in return to the investor after when they are payback. And usually investors do this type of investment or this type of municipal bonds when they want to support the local government, they want to support the community, they want to support the society. So short municipal bonds are issued by the government at local level and provincial level, right? And they are like treasury bills as well, but they are not safe as treasury bill, as treasury bills are backed by federal government. They are mostly financially strong, but at provincial government they are not as strong, but still they issue this type of bonds, and this type of bonds are issued all over the world by local level, local government level, provincial government level. Commercial paper is very high quality and secured short-term cooperative debt. It's issued by the private company. Remember, commercial paper is issued by a private company or private corporation, and it's issued for the period of from 30 days to 9 months. So from 3 months to 9 months, it can be secured and issued to the public, and it is usually issued when the companies are in need of money, and it can be bought back by the company if they want and they get financially good position. But usually commercial paper is issued by a private company when they are in need of money. There are two types of commercial papers: direct commercial paper sold directly to investors and indirect commercial paper sold to dealer at discount rate. Those commercial papers who are sold directly to investors are usually financial firms, frequently large needs for short-term cash, direct issue lower interest cost by 1/8%, and it's those simply those commercial papers which are issued directly to the uh, investors are usually given a discounted rate, and though usually to investor are not given a discounted rate but at the full payment, right? There is no discount when commercial papers are bought by investor directly, but when indirectly commercial papers are bought by dealer, the dealer discount is there. Dealer is given discount on such buying and selling, and that is the dealer profit margin as well. So commercial paper issued to investor has no discount, and commercial paper issued to dealer has a bit discount, right? As of January 2020, there was about $1.44 trillion outstanding in commercial papers issuance against the different companies working in Pakistan. Bankers acceptance. Banker acceptance are like a certified check from a bank, except that it's payable on some future dates where a check is payable immediately. Banker acceptance are usually created in process of international trade and are sold by banks. Banker acceptance is basically a guarantee issued by the bank, and it's like a check when if the company party A is trading internationally, and they are bank a party between letter of credits party between them. So banker acceptance is give you a guarantee, a surety that you can have this money cash. This check can be cash anytime at future date if you need it in case of trade completion, in case of imports completion, export completion, any trade transaction completion, and as soon as transaction get completed, you can cash that money. So banker acceptance is basically a surety to the importer or exporter, and it's a third party guarantee by the bank to the both importer and exporter at the same time in international trade. Long-term bonds. Bonds are interest-bearing debt security with original maturities greater than 1 year. Bonds are issued to raise capital by following types of issues. As we studied bonds many times, but long-term bonds are those bonds whose maturity is more than 1 year. There are different types of bonds like federal government bonds, federal agencies bonds, state and local government bonds, corporations bond, various foreign issuers bonds, and these are issued by all those government and private company, government organization, private organization to when they are in need of money and when they want to raise their capital. We have different federal agencies like in the United States we are mentioning here different which are issuing these agency securities, government sponsored enterprise in US which are issuing agency securities to raise money and raise capital. Then we have municipal bond. Municipal bonds are issued by state and local government department. The interest paid by these bonds are exempt from federal income tax or government duties or taxes. And these are issued by local government level or state level when they are in need of money, and they are usually issued with a promise to pay interest in future on that. Like if you issue 5 lakh rupees mutual bond, after 5 years you will get like 5 lakh 50,000 rupees payback when you sold back that municipal bond to the municipal department or to local government department or to state department. So this overall process of sending issuing bonds at computed interest rate and lower prices than face value is to the general public by the local government department or provincial government department or state departments are known as municipal bonds. Thank you very much. Take care. Allah Hafiz. If you have any question, you can ask in Google Classroom. Thank you very much.